The date is Wednesday, May 14th. This will be a Watchhimtrade.com webinar in which I answer questions that were submitted by you guys. So let's get to it. First question I received was, do I ever base my entries and exits on the actual options level 2 or time and sales instead of the underlying stocks level 2 or time and sales? The short answer is no. I typically always rely on the underlying stocks price action or level 2 and time and sales action to dictate my entry. My entries are always based on the price action of the stock. Notice I said my entries. Exits can be a little bit different, and I'll touch on that. It comes down to targeting where I want to get in, though. I target where I want to get into a trade based on the stock. If it is testing a support area that I want to trade against on the long side, then that support area will be my stop loss. Or if I'm targeting a resistance area that I want to trade against, then that resistance area will be my stop loss once and if I enter the trade. So then once that area shows up, it becomes a matter of what does the price action look like? If I'm targeting, for instance, today I made a trade on Apple. I went long the calls at 9:53 or so when the stock was testing around 595. You can see this price action right here. Apple had made what I felt was a solid move up, and then I said, all right, as long as it's staying, around 595-ish, I'm going to enter a trade. So it pulled back to below 595, but it was kind of in this 594, 595 window. So I entered a call trade based on the fact that I knew in my head, hey, I'm going to trade Apple versus 594, 595 action, and then I enter the trade. It didn't have anything to do with where the option was trading at the time. I knew in my head, I'm entering Apple if the entry that I want shows up based on the underlying stock. Had nothing to do with the price of the option. Now, exits can be different though, and sometimes exits will be based on the option I'm trading versus the underlying security, because sometimes your stop loss can get tested for a long period of time without giving way, without really negating the setup. The stock price action might not negate the setup. And we saw this today multiple times when I was trading Tesla. I took a loss on Tesla today on 2 separate trades at the open or near the open without the stock really having violated my stop loss all that much. I said I was trading it versus the 189 to 190 range, and I was entering puts on this action here. My first entry on the puts was 931, so pretty much just right at the open. And I said, all right, I'm trading Tesla versus 189 to 190. Now, I ended up exiting Tesla at 940, kind of around this price action. Now, if you look at it, you'll see that it didn't get beyond 190, my stated stop loss, until 10 o'clock. And then even after 10 o'clock, it ended up coming back below it, and there were still potential short trades versus the 190 area. You can see Tesla never was really making a good move above 189 to 190. So that was a situation where the stock price action isn't negating the setup, but the problem is in that situation, theta starts coming into play, and you get into a situation where your option price starts to go down even though your thesis behind the trade is still intact. I'm shorting Tesla versus 189 to 190. It hasn't taken out 189 to 190 with conviction. So technically, the setup is still intact. But because of theta, my option is starting to go against me because there's just a real lack of movement overall. So in that type of scenario, then yes, I will base my exit off of the option because I can't allow a 10% stop loss to turn into a 20 to 25% stop loss simply because there's time transpiring where the stock's not really moving. It hasn't triggered my stop loss, but at the same time, it hasn't done what I need it to do. It's not going in the direction I need it to be going in order to make the trade profitable. So this is why time frames are so important with your trades. You need to have a time frame for when you expect the move to happen. For some people like me, usually that time frame is between 5 minutes and 30 minutes at the most. For other people, maybe you're a swing trader, that time frame can be 1 day, it could be 1 week, hell, it could be 1 month if you're, swinging a position more intermediate term. Bottom line, you have to have expectations. You have to have criteria for, all right, I think this move is going to happen, number one, and I think it's going to happen by number two. And if it doesn't happen by that date, then something's kind of wrong. Think of it like dating. Trying to get a girl to like you, your courtship of a woman. You have expectations with that courtship. It's going to work out. You guys will start a relationship. But you could find yourself in a situation where you go on numerous dates, time and time again. Everything's going well. You keep having good dinners, but maybe the relationship hasn't progressed to where you want it to get to. And this has been going on for a month now, and you were expecting the relationship to have moved further along. What happens in that situation is you then make an adjustment. Even though there's nothing wrong with what's happening in that particular relationship, it's the fact that there's not everything that you wanted to be happening by that point. All right? So that's my analogy for that. And sometimes I refer to that type of stop out when you exit because nothing's happening when you wanted it to happen by a certain time. I refer to that as a time stop. That's why on a day like today, one of my stop outs was due to the fact that I had said I would like Tesla to go below 188 by 11:30. And that didn't happen. I ended up stopping myself out of the trade at 11:20 once it became clear to me that, hey, you know what, even though it hasn't really stopped me out based on the price action, it's stopping me out just because of the way that it hasn't come below 188 or looking like it's coming below 188 by my time frame. So again, entries always has to do with the stock price. Exits can be a little bit more mixed, but again, still usually has to do with the stock price. I will look to exit my position once my stock target is hit, but you do have to make adjustments if theta is coming into play. You need to have that time frame. Next question. If I recall correctly, and correct me if I'm wrong, I think you had stated that you focus more, if not only, on options now. Why do you focus more on options now as opposed to OTC penny stocks? I have heard some say that OTC stocks are more predictable in terms of level 2 action compared to big boards. What are your thoughts on this? Well, first of all, you are correct. I have shifted away from penny stocks pretty much completely and to options. So that is true. And the main reason I've moved from penny stocks to options is that I find options to be more challenging. I'm kind of a fulfilling person, and this might sound a little weird, but I'd honestly rather make $1,000 trading an option than make $10,000 trading a penny stock because I know that options are harder, and I know more skill was involved in making $1,000 on that option trade than there was making $10,000 on that penny stock trade. You just won't convince me otherwise. But ultimately, I'm trying to become the best trader I can be. I have dreams for myself. I have goals for myself. And where I want to go, you just don't see penny stock people going where I envision myself going. You don't see CNBC, they don't exactly interview the best penny stock trader out there. People aren't paying money to go hear a leading penny stock trader talk at these investing conferences or the money shows and trade shows and whatnot. They're interested in more advanced type of skill trading, which to me, that's what I believe options represent. Don't get me wrong though, that's just me. If you're killing it in penny stocks and you're enjoying that, then by all means stick with it. Options trading is definitely harder in terms of predictability versus penny stocks. I would totally agree with that. But again, for me, it's about fulfillment. I did really, really well when I was trading penny stocks. Problem is deep down, I just didn't feel very proud of my success. When people ask me what I do, if I'm out at a party or at a bar or something and we get to talk and shop about trades, it's like I'm talking about penny stocks and it's kind of just illegitimate, and it feels illegitimate when I'm trading it. Now when I go out or if I'm talking with family or friends, I'm very proud to say, hey, I'm trading Google, I'm trading Tesla, I'm trading Apple, I'm trading the most popular stocks in the world, all right? And whereas penny stocks, they just kind of have this shady aura to them. And quite frankly, sometimes I was ashamed knowing that I made 10 to 20,000 off of a complete pump and dump, and the only skill I possessed was knowing to get in at the start of the pump and get out before the dump. Some other more personal reasons as to why I focus on options over penny stocks has to do with liquidity and the nature of both markets. With options, I get to watch the same 6 stocks every single day, or however many I'd prefer to keep an eye on every single day, and I know that for the most part, one of them should provide me with a tradable move at some point in the day. Now, you do have the exceptions where you get a couple days stretch every few weeks where things are just quite slow across the board, and it's like that actually right now, but it never ever gets even close to as slow as the liquidity does in the penny stock market. With penny stocks, number one, I have to hope that there's a hot sector, such as the weed sector or small penny stock biotechs or gold. A few years ago, the gold sector in penny stocks was really hot. And if that's not happening, then I have to sit around waiting on the next promotion and hope that it's a good promotion, and then hope that it's not going to get halted. And if you want to see signs of that, we just look at PHOT, which got halted here for a long period of time, was around 50 cents, and then doop, cut in half, down 50% for anybody holding, nothing they could do. And now the liquidity is all gone. You can see it went from trading, 40 million shares a day to now it's only trading 7 million shares a day, and there's no level 2. Then, all right, so now I need a promotion to trade. If the hot sector stock gets halted, all right, well, you look at the promotion, PGFY just got promoted up, and what do you know? Hey, how come there's no volume for PGFY today? What's going on? Well, that's because this piece of shit got halted. So it's just a mess, and I don't want to deal with that stuff. I'd rather have the consistency of options. I never need to worry about any of these stocks getting halted. I never need to worry about, hey, are they going to trade hundreds of millions of dollars today? Am I going to be able to get in? Am I going to be able to get out? You don't have any of those questions. So, the fact that it's more challenging and I feel like I get more out of it and I'm prouder of it. Also, I feel that I'm helping people. With penny stocks, again, kind of this shady pump and dump aura. With options, I feel I'm doing a great service having this business. If I can trade well and I can truly teach others how to trade options well, that's very fulfilling to me, and I feel really good about the job I'm doing because I know in my heart that I'm really helping people and I'm really making a difference. And I just didn't ever feel that way, even when I was trying to help people learn penny stocks. Next question. Can you explain the best strategy to use when placing orders? What is the quickest and/or best method to getting an order filled? Also, if you could, please briefly comment on using trailing stops stop limits, etc. All right, so this question comes down to two segments. It has to do with entries, number one, placing your orders on entries, and then also placing your orders on exits. So when it comes to entering my position, I always use limit orders. I always use limit orders when entering a trade. I find the best method to getting an order filled, again, comes down to looking at the underlying stock, figuring out, all right, where do I want to get in at? And then once it approaches that area where you want to get in, whether it's on the long side or the short side, you then place a limit order on the option I'm trading at the bid or slightly below the bid. And if my bid doesn't fill as that price action is occurring and I definitely want in, then I'll go ahead and hit the ask. And most brokerage platforms, if you want to hit the ask, allow you to just double click just like I did, and then you see my limit order turn to 153 on the screen here, this entry screen. Now for me, I have multiple confirms on my order placements. But if you don't want to worry about that and you want to place super quick orders and whatnot, okay, you can see how I have this multiple confirm box just popped up. If you don't want to do that, your broker should have a setting where you can get rid of the multiple confirms. I do that because I'm conservative. I like, double checking things, making sure I'm not making a mistake. But, that half a second, maybe it costs me an entry sometimes. So that's one of the ways to place your order more quickly, is make sure that you don't have any confirmation settings tied to your account, because that will take a half a second or a second for you to process and then double click everything. But with the entries, again, I always use limit orders. So that's one technique. Just simply when the stock approaches the area at which you want to buy your position, then you just go ahead and place your bid, and in most cases you'll end up getting filled. Now the other scenario, or I shouldn't say scenario, but the other method you can do is you could really incorporate some of the options Greeks into your strategy. For instance, delta. Okay, delta represents the point move or the cent move that the option will move for every 1 point move in the stock. So for instance, if you take these 190 calls on Tesla, trading around $3, you can see that delta is 0.56. So what that says is that in theory, if Tesla drops $1, these calls will decline 56 cents. If Tesla rises $1, these calls will decline 56 cents. Now it will have a slight change to it because gamma and theta and vega are going to, they're all changing as the price is moving, but in general it's going to be kind of around 56 cents as long as it's around these prices. So you can see that the last price was 190.94 or so. So the other way you could do that is if the market was open right now and I was saying to myself, all right, I want to trade Tesla on the long side. I like it for a 195 target, but I don't want to buy it right here. I'd prefer to buy it closer to 190 because 190 is that round level, and I've been trying to enter positions as close to round levels as possible because that helps me minimize my losses. So what you would do in that scenario, if that's your mindset and your idea for the trade, you could place a bid at $2.50 on this option, the 190 strike call. And then if Tesla does pull back to the high 189s or low 190s, all things being equal, the option is going to pull back 56 cents, so it's going to be between 240 and 250, 255, give or take, and you could fill that position that way. I personally like placing my bid as the price action is happening. I don't like leaving the bid open and then having to wait 20, 30 minutes or something for it to fill. It's just too many variables. I feel like I like being in control more. But, we're all different. It's definitely a viable strategy to figure out, hey, where is this option going to be based on what the stock does, and then you can have an easier time placing your order ahead of time so you're not as focused with trying to get filled when the stock is actually approaching the price you want to get in, because when that's happening, your order's already in there and you're likely already getting filled. But again, that involves more analysis of the Greeks. You have to be familiar with them. You have to understand how to read them. I'm familiar with them. I understand how to read them, but I don't have them up while I'm trading. I don't look at the Greeks when I think about an entry. I just kind of look at the price action and think to myself, all right, well, let's just watch the stock and then let's see what the option's doing and go from there. The other method that I'll use sometimes to make it easier on myself instead of having to look at the Greeks is I'll look at my time and sales on the options. So for instance, these 187.50 puts, I was able to buy at $1.47. Well, if you look at 355, you could see that they were also at $1.47. So what I could do in figuring out where I want to place a bid is I say, all right, maybe I want to buy, right around 150. The last time they traded there was 5 minutes before the close at 355. All right, let me look at 355. The stock was testing 190.80, 191. So if it's testing 191 into the close, I should be able to place a bid at 147 and get filled. And that is actually what happened. I am in a Tesla put at 147, and that's kind of the method I used to fill that trade. So that's on the entry side of things. Now, on the exit side, I will use a mix of limit orders and market orders. Again, it works the same way with the limit orders. In general, as the stock is approaching my target, I will see where's the option trading, and I will, in most cases, just double click and sell to close. All right, as long as it moves up just a little bit more, it's testing this price, so I should get filled right there. What I will do sometimes, though, is I'll use a market order to exit in two scenarios. Number one, the time where I use the market order most often is when taking losses. Market orders get you out right away at the current bid. You don't have to worry about, all right, I'm going to try placing this bid at 144 to sell, to get out. Okay, yeah, I want to place it. And then all of a sudden the bids drop, and now the best bid is 143 or something, or 130, and then I'm having to constantly adjust. Okay, now I'm trying to place it at 137. All right, let me make it there. Up, the bids are still dropping, and it's like, well, fuck, I'm chasing this thing the whole way down. So what I'll do generally when I'm taking a loss is, for me, it's the close button right here. So the market's closed, so it won't let me do it. But if I just put close, if I just hit close when the market's open, this just gets me out ASAP at the current bid. Market order fills me right away, no problem. And I like that for taking my losses, because if I'm taking a loss, I know I want to get out. I don't really care, what's going to happen next. The only thing I care about is getting out ASAP, because I believe that this thing's about to go against me and this loss is about to start increasing. So I just want out. So I'm not going to worry about, my limit order, trying to get cute, trying to fill on the ass. Just get me the hell out, and a market order will do that for you. Now, sometimes you'll have a situation where you're in the green, because remember, I was just talking about a loss with a market order. You'll have a situation where you're in the green and the position is going in your favor. And, the bids are starting to stack. You got in at 150 and now they're stacking above $2, and stock is starting to make a run, and you're trying to figure out, how much farther is this thing going to go? I kind of want to take profits here, but at the same time, if it's going to keep ripping another $1 or so, then I want to be able to maximize the profits. So what I'll do in that scenario, and I tried to do this with Apple today on my sell order at 10:06. All right, I want to point this out. Notice my sell order on Apple. So here's my trade. Oh, that was a bad line. Here's my trade. I'm circling it. All right. So I bought the position at 9:53 at 272, and I sold the position at 3:55 at 10:06, just about 10:07. Look at my limit order though. Look at what the limit order was placed at. The limit was at 3:30, and I sold at 3:55. Now, the reason it looks like that is because as Apple was rallying higher, I was trying to maximize my profits. You can see at about 10:07 when I sold, that was this move right here. It had just started this move. Just broke to a new high day, so I'm thinking, all right, here's a new high day. I know I want to lock in profits, but I want to maximize the profits because, the high day, hey, maybe it's going to be 596s, but maybe it's going to be 599s, and it's going to be, right here in the next 5 minutes. I'm going to feel stupid if I sell that position and all of a sudden it's much, much higher. So what I do in that scenario is I keep my limit order below the best bid. So on these 595 calls, that's why you see my limit order was 330, but my fill price was 355. That's because as Apple was increasing, the bids were in the 350s, 360s. I was trying to maximize gains, but I know that, all right, I'm trying to maximize gains. As soon as it looks like it's stalling out, I need to get the hell out because these things are going to drop quickly. The bids are going to drop quickly. So that's why my limit order was actually below the best bid, because I can just hit it and I'll get out at whatever that best bid is. That's another situation where you could have just used a market order. What I'm doing though is I'm really watching level 2 closely in those scenarios where your target's starting to get hit, but you want to see, hey, maybe this thing starts running a little bit more. You really watch level 2 and you really watch time and sales to try and get a feel for how much more is left. And then as soon as you feel that the move is ending, then I usually just whack the bid and get the hell out. The other way to play it though would be, you planned on selling in the 596s. You don't care if it goes higher, so you're just on the ask. As soon as you see 596s start to print, you just double click the ask and you'll get filled. As far as, talking about trailing stops and whatnot, what I just said about, watching the price action and keeping my limit price below the best bid, it's kind of like a manual trailing stop. So a trailing stop says that once you get to a certain profit point, as long as it keeps advancing and stays above a certain mark, you are going to stay in the trade. So for instance, if you get to a 25% gain, you can raise your trailing stop to be 20%. That says, as long as it's above a 20% gain, I'm staying in the position. And then say it gets to a 40% gain, you can then raise your trailing stop to 30%. So it stops you out if it goes below that 30% gain. And the strategy behind that is you're not giving back gains or a significant portion of your gains, but you're also keeping yourself in the trade to leave yourself exposed to even more upside potential. Myself personally, I don't ever use trailing stops. Maybe I should, maybe I shouldn't. It's, again, just kind of control. I'm watching level 2. I'm watching everything in real time, so I'm just more comfortable using limits. Maybe I'll use them in the future. But that's the purpose of a trailing stop. I've always envisioned a trailing stop as more for swing traders, people who are taking positions on a day-to-day basis. I don't feel like I see many people using them as day traders. I've also don't see them used often with options. I do see them used a lot more with stocks, stock prices, but by all means, experiment and try them out because they can certainly be useful, and that is how people use them. Now, the one order that I will use sometimes is a stop limit or just a stop out. Sorry, I'd use a stop market. All right, and what I do in that situation, it's pretty self-explanatory. This is for maybe, you're in a position, excuse me. Maybe you're in a position, but you want to go to the gym or market's kind of slow. Today was a perfect example of a day where a stop price would have come in handy. You're in a position where you want to go to the gym or you want to get outside and you don't want to have to worry about what your stock is doing. All right, so I'm in this Tesla trade, for instance, at 147. What I could do is I could place a stop order and I say, all right, it's at 147. I'm not going to take more than a 10% loss. So 10% loss of 147 is 14 cents, so 133. So I would enter 133 for my stop price, and what that says is if the option prints 133, prints below 133, it's going to stop me out right away, and it's just going to sell at a market order. Now, you asked about a stop limit. A stop limit is a little bit different. So a stop limit is a stop price that stops you out, but then a limit price to buy the position back. So maybe I'm stopping out at 133, but I want to buy it back at $1. Okay? So this current position, 147 that I have, again, that's a scenario where you think you're going to be right overall about the trend of the trade, but maybe now instead of shorting Tesla at 190, you just would rather short it at 193 or something. So that's a scenario where you'd use that stop limit. You want to stop out if it breaches resistance 1, but you want to get back in at resistance 2. That's kind of terminology you see a lot. Maybe this line right here is resistance 1, so you're stopping out on a break above that, but then up here is resistance 2. You're still bearish as long as it's holding below resistance 2, and you want to get back in at that price. For me personally, I'm not using a stop limit because if I'm stopping myself out, I'm just going to reevaluate once it gets to a different price level and go from there. But that is how people would use them. Again, I envision that as being more for swing traders or day-to-day, week-to-week position traders as opposed to momentum day traders like myself. There are, depending on your broker, more advanced order types you can use. For instance, I have an OSO order, and I could exit positions. I could sync it up to exit me based on a break of first support or a break of my first trend line. There's all types of different contingencies I can place to it. I can enter to buy on a breakout, buy on a fade. There's all types of different customizations that you can do. But again, all brokerages are different, and you really got to mess around with your own platform to figure that stuff out. The orders I use the most in order are limit orders number 1, and again, that's primarily for entries. Market orders number 2, that is primarily for exiting to take a loss, and then I will use a stop order sometimes, but most of the time I'm at the computer anyway, so if I'm stopping out, I'm just doing it manually.